Okay, so it seems like all's okay. Okay, everyone, I'm just going to talk. Please just spend a couple of minutes, a couple of seconds even, looking at our disclosures, please. I know today's today's Trading Tuesdays with myself, Kathleen Brooks, is okay. So it looks like sounds okay, Bob. Maybe you need to, or okay, great. Everything seems fine there now. Okay, guys, I know this is at 10 o'clock this morning. Normally it's at 11. There's just a little bit of confusion right now, but we will be back to 11 o'clock from next week. So 11 o'clock London time. Don't worry too much about GMT and BST. It will be 11 o'clock London. So just looking at our disclosures, this presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This presentation or webinar has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodity Exchange Act. Contracts for difference, or CFDs, are not available for US residents, and none of the service or investments referred to in the presentation are available to persons residing in any country where the provision of such services or investments would be contrary to local law or regulation. So now that we've got that mouthful out of the way, let's just put that down. Now, guys, just bear with me 1 moment. I've just got to pull up my charts. My charts decided to die on me just before we came across here. So you can look at my lovely flowery desktop background instead. So you should be able to now see my chart here. And Alan, you're looking for euro and cable. And as you can see here, let's go straight to euro here. As you can see, we think it's limited. We are hitting resistance for sure. Two things I want to point out to start with when it comes to euro dollar. Obviously, we had Thursday post Draghi press conference. A big surge higher by the bulls. That represents this candlestick here. I mean, that was a great day. One of the biggest daily gains that we've seen for quite some time in euro, probably since way back to January. The uptrend looked very much in place, but we are hitting a bit of a ceiling, which coincides with that high that we did break through. We got to 139.15, but that 138.90 to 138.20 level is acting as a very, very sticky level of resistance there, and we are just backing away from that level right now. We've lost that 138.50 handle as well, but we do think it's limited setbacks at the moment. 138.12 should act as a fairly good support. That's the midpoint of the rally from Thursday, from that post Draghi push higher in the market. So as you can see here, it really is looking. We are still looking strong, even though we are set back. There are a couple of things I want to note. Number one, it's a bit disappointing that we didn't get that 139 plus weekly close on Friday. That was disappointing. There is no doubt about that. The bulls will have been disappointed by that. But it maybe just takes a little bit more time, and maybe the bulls just need to be a bit patient. And there are some positive signs coming off the momentum indicators. This is the daily MACD, as you can see, well above the zero line, which still indicates bullish momentum in the market, but we are getting stuck at this level, which is significant. In terms of, where can we go next? Sorry about that, guys. I'll just get rid of that. Obviously, as I said, the 138.12, so the 12th level, that's the midpoint about there of the uptrend from Thursday, and then we're looking at these lows from March the 5th. So that would be the low from Wednesday ahead of the ECB meeting, which comes in at 137.08, and then we're looking at 136.5, or just below there, 136.43. Which is the February 27th low. So overall, we could potentially still be in an uptrend here. Now, I just want to show you just another chart. Those of you who join me for a while will probably be able to guess what it is. Yeah, it is the Ichimoku, so we're well above the top of the Ichimoku cloud, but we are just stalling here, and it is concerning for sure. The market does seem to be taking a breather. That is quite normal at big levels. What you tend to see, when you approach 140, there's a few things you need to be concerned about. First thing, obviously, is, the market tends to react in three ways. It goes through it, it doesn't, and it fails, or it moves sideways for a while. We're in consolidation pattern right now. That's for sure. But we are watching it closely because we do think a break below 138.12 would be quite negative. We want to stay, largely because it would tend to reverse some of the gains that we've seen. It would tend to reverse some of the gains that we've seen. Now, one thing, possible shooting star, you've mentioned that, Alan. Let me just go back to the other chart. It's probably easier to see here, maybe. You could argue that's a long-legged doji, actually, which was Friday's close, I believe. That does suggest maybe a little bit of, and you can just see it here as well. That does suggest a little bit of uncertainty in the market, maybe a little bit of hesitancy to push it higher. Again, I don't necessarily think that will indicate that's a bearish sign right now. I think we need to see how price action plays out. But I do think that it means that it's going to be that potentially. Hi everyone. I think that's fine. Sorry, FX Street. Just double checking that everything's okay on my end. I just had a pop up there from WebEx, but I believe everything's fine. Okay, so here, just going back to this long-legged doji, it does suggest that there's a lot of selling interest really above 139. That is quite normal though, because 139 to 140 is this key psychological level. I mean, if we go back here. This level here that we've been at, this 140 level, is significant. We're kind of traipsing into that territory here. We were, around 140 back in late 2011, and obviously this is a multi-year high. So profit taking, everything else, it's a good excuse to take profit, I should argue. Okay, well, it seems like everything's fine. Pan, I'm not 100% sure what you're talking about. 141, okay, all right, yeah. No resistance to 141.71, I think, is what you mean. Yes, that's true. If we were to get, on the upside anyway, if we do manage to hold hold our support, as we said, 138.12 now is looking quite strong. We need to get back above 138.93, 139.15, and then 142.47 is the October 2011 high, with 140.50 being the 138.2% Fibonacci extension of the December to February sell-off. So they're kind of levels that we're watching. I'm just going to go back to that December chart here. So this, but as I said, yes, I think it's tortuous where we are right now. And the euro is not the only one that's kind of exhibiting signs, maybe of a little bit exhaustion to the upside, even though the momentum indicators still look good. The other thing I know that Alan wanted to talk about, and which I will talk about now, is cable, because I think it's really interesting what's going on with cable right now. As you can see, cable has just traded sideways. It stayed in consolidation. It didn't manage to break to fresh highs after last week, during the kind of, rush to risky assets at the end of last week. What a difference a week makes, hey? Very, very different from that time in, just look at it in a more concentrated way. This is where we've gone today. We've fallen, 9:30. We got some good readings, actually, of production data out of the UK. It suggests that, the economic recovery in those production sectors are doing quite well. So we managed to move higher, but then we kind of came back again. Again, does Carney have the gift of the gab? He speaks, traditionally when he speaks to the Treasury Select Committee, like he's doing today, it can sometimes have a bit of a positive impact on the market. And we've seen cable rally before, but he's not really got the gift of the gab today, with his words only having a slight impact. So again, he's just sticking to the same message. Nothing too market moving, by the way, coming out of there as he is talking as we're speaking right now. So as you can see, still looking quite weak in cable. Certainly, haven't really been able to sustain moves higher. 166.15 now on the downside looks like very good support. If we get a daily close below there, that's going to be quite negative, obviously. And we could easily end up seeing further declines. The bullish trend does persist. I mean, that's kind of what, a lot of people are talking about here. But we are looking at, even though we are weak, we are looking at a short-term period of consolidation for sure. Whether or not it turns into something deeper than that, we don't know yet. As I said, the weakness that we've seen yesterday, it doesn't alter the broader bullish picture. And we would kind of expect, let me just draw in, we would expect some good support to hold there, including the 38.2% retracement of the February advance, which comes in at 166.05 thereabouts. So we're currently trading around about 166.24. So we'll be looking very closely to see if that 38% retracement holds, and then we'll be looking at 50, which is 165.38. If we get below going down to kind of a 38% fib retracement is not that big. It's a normal pullback. Obviously, if we get below 50%, if we retrace 50% of the February advance, that's slightly more concerning for the bulls, certainly in the short term anyway, and suggests that the pullback could be just a bit deeper, and maybe that 168.23 level is a more medium term top. So that's kind of what we're watching out for there. Now, this is obviously a little bit of a frustrating time in the market because we are just kind of consolidating. We don't really know whether we're going one way or the other. We've had that long-legged doji in euro. Right now we're having a bit of a pullback in cable, but nothing to worry about. What about looking at it from the other side of things, where things look like they could potentially break out rather than fall? Let's look here at dollar yen. Dollar yen's an interesting one. So many people over the last 3, 4, 5 months have been looking for dollar yen to be kind of the uptrend of the century of this year. The uptrend that we can all jump on the back of and be happy. Well, that hasn't quite happened, and we're still quite neutral on dollar yen. Even though, it obviously made some positive signs on Friday on the back of that better than expected payrolls number, is still stalling. It just hasn't been able to sustain gains above 103.65. That is your next level of resistance. And if we can get a daily close above there, which is the 61.8% fib retracement of the January to February setback, let me just draw that in for you. We really need to get above this level. Otherwise, it's going to be very hard for us to get back to those late December highs where we got to kind of well above 105. In fact, we got to 105.44 on January 2nd. So that really for us is absolutely critical. A daily close above there would be a very bullish development and would confirm would confirm that the bulls would be on the side of dollar yen for now anyway. Resistance, as I said, is 105.44, which is the January 2nd high, ahead of kind of that 105.75 level, which is obviously anything above 105 is symbolically important. Well, I think in this environment, if we get above 103.65, a daily close above there, the market would be quite happy just to push us up to those January highs around about 105.44, because we're just lacking, we've just been able to kind of attempting to break out and then pulling back, attempting to break out and then pulling back. It's been very, very frustrating. There are basically a plethora of macro themes at the moment working their way through the market, but not one of them is settled to become the most dominant theme. That's certainly what we would argue. The market is still struggling to find direction. It's still struggling to see, is it geopolitical concerns? Is it Fed tapering? Is it kind of weakness in China? Is it uncertain economic data out of the US? There's just so many themes out there, and it is quite difficult to decide which one is worth taking seriously, which one is the one that could potentially drive these markets higher, or might drive these markets one way or the other. And we just haven't found that yet. So as I said, with the dollar yen, we think that it's going to be we think it could look good. We're pleased that, we were able to trade it while it was trading higher on Friday and towards the end of last week. But we are a little bit concerned that we could still just be in consolidation territory if we don't get above 103.65. On the downside though, 101.20 held a very, very good support in the sell-off at the beginning of last week. But we'd also be looking at kind of 103.10 in the very, very short term, and then 102.50, which is the 38.2% retracement of that decline. So we are watching this very, very closely. It's a time when you really do have to start looking at kind of, what price is doing in this in an environment whereby there's no clear fundamental driver. Okay, the other thing that I wanted to show you, let me just look at this, is, oh no, that's not it, SPX. A lot of people have been asking us all, really, what's been going on with the S&P 500? Are we bullish? Are we bearish? What are we looking for? Well, I would argue that we're neutral. Obviously, I'm not the kind of stocks expert. My colleague Fawad is. He writes a lot of our content on stock markets and commodities, which you can find on our website. But just looking at it, from my novice eye, I suppose, as you can see, look at the tiny candles there. Just extend that. The tiny candles, the daily range is just tiny. It does suggest a complete, lack of direction one way or the other. We had a nice push higher. Last week when we were kind of reversing this candlestick, this decline here, or last Monday's decline, which came on the back of the Ukraine fears, had a lovely reversal in risk, and we made fresh record highs. But this isn't the type of market where this is a really tortuous type of market. It suggests potentially the end of the uptrend. And the reason why I say that, and I hate to disappoint you bulls out there, but usually what you tend to see when you break fresh record highs, or what you can see, if it suggests that, a fresh record high is going to be just the start of another leg higher, you see, some follow through, and we're not getting that. As you can see, we're seeing, very tiny, look at them. They're just absolutely tiny little daily ranges. A lot of profit taking, some people willing to pick up the dips as we've seen here, but equally very much willing to sell any type of push higher again. 1883 is the high. Is that fresh record high that which was registered on Friday, but even then we couldn't really follow through, and actually the low wasn't even that far away. We were only up about 15 points in the S&P on Friday, even though we got that better than expected payrolls number. So I would just say, just be a bit cautious. It doesn't look at the moment like we're going to fall off a cliff anytime soon, but obviously if we were to get back kind of below that 1850 level, that would suggest maybe a deeper pullback, maybe back to these kind of this area of moving average support. 50-day comes in at 1827, and then 1803 is the 100-day moving average. But as I said, right now we're just kind of moving sideways, because even though the data was better in the US, it wasn't dramatically better to override some of the fears out there. And it's not just fears in the geopolitical space or even in China that's worrying S&P 500. It's also some of the economic fundamentals. Now I want to show you another chart. Just stick with looking at this one for a moment, and I will see if I can bring it up. So this is a chart. Oh, sorry guys, it's not. Bear with me one moment. This is just an earnings surprise index in the S&P 500, and as you can see, the 2013 earnings, the surprises have been kind of more on the negative side. So usually, analysts tend to be quite pessimistic bunch. So the markets do tend to kind of surprise on the upside. But where you see that big push higher in stock markets, a bit like we saw, kind of what we've seen in the past, just doesn't necessarily look like it's happening right now. We haven't really seen a fantastic set of results. They've been okay. They've been slightly above expectations, but not good enough for us, which is why we're seeing just this stalling pattern in the S&P 500. So that's certainly one to watch. And it does, there's definitely unfinished business in the market, and there's a bit of nervousness, which is permeating other crosses. Now the other, when we talk about kind of risk, we obviously talk about stocks, but we also talk about Aussie yen and some of the this is, your traditional carry trade. As you can see, Aussie yen again, that also just kind of traded traded sideways basically. It got to a high of 95.70, but it didn't manage. Just bear with me, guys. Okay, guys, sorry about that. Just my fault. So as you can see here, we had a with Aussie yen being your typical kind of risk friendly pair, I guess. We had a move higher on Friday. A lot of people were thinking, hey, we've broken out, we could move higher, move back to today's October high. Unfortunately, then we turned around again. So just more frustrating news in the market. People are desperate to find some trends, and there just haven't been any. Even in this type of scenario, like, an Aussie yen, which can be, if you think the risk is going to be on, that would be one that you'd expect to recover. But it didn't. It has managed to find some support ahead of 92.55, which is the 100-day moving average there. But it's just a frustrating situation. We just haven't been able to extend any upside in that 95 or these highs from October that we see here, which come in around about 95.80, are still very, very elusive for us. So that's kind of the key concern. Now, I do want to show you Kiwi because obviously this week, in fact, overnight tonight, we will hear from the RBNZ, and they are fully expected, or the market is fully expecting them to hike interest rates by 25 basis points. This is a very symbolic act. Largely because, they'd be the first of the G10 central banks to normalise interest rates. And the one thing I would argue, though, is just because the RBNZ does it, we don't expect this to freak out the markets. Number one, the RBNZ is a small central bank in global terms. And number two, we also have, it's unique circumstances for New Zealand because the reason why they hiked interest rates in 2011 was on the back of that terrible earthquake in Christchurch. So they're just trying to take out some of that stimulus as the building and the repair work has been done now pretty much from the devastating earthquake there. So what we're seeing here, as you can see, we're kind of hitting that 85 level. 85.50-ish is the kind of top of the recent range. We've been attempted to get there. We seem to be buying into this meeting. So the risk is that you buy the rumor and then you sell the fact. Our view is, that all economists on Bloomberg who are polled for this, there were 15, so not that many, I granted, but they all are in unison that the central bank will hike interest rates by 25 basis points. There are two risks out there, big risks, which we think are quite low probability, but they're still big risks. Number one, if the bank doesn't do it. If the bank doesn't do it, I wouldn't be surprised if we turn around and we potentially get all the way back to this 50-day moving average. To this 50-day moving average, which comes at 83.05, and that could potentially cushion any below. But overall, if they don't hike interest rates, that would be a very negative development for the Kiwi dollar, and we could actually see a lot more. We could actually see kind of the market really lose patience with the RBNZ and actually start. Start to kind of push this lower, maybe back down to those February or, say mid-February lows, which came in at 82.45. I don't necessarily think we'll get to that 80.50 low that we saw in very early February. That was when there was a lot of risk aversion in the markets, and we're just not seeing risk aversion in the markets. What we're seeing at the moment is apathy in the markets. So that's kind of the key thing here. So as you can see on the upside there, as you can see though, we certainly are strong going into this RBNZ meeting. So for us, we could, if they do what the market expects of them, yes, there could be a bit of a knee-jerk reaction higher, maybe above 85, which would be quite symbolic, maybe to that kind of 85, 20 to 30 level. But we think overall that we'll just kind of consolidate, and whether or not we push higher, maybe get to those, these highs from end of April last year, whereby we got to kind of 85, 80. That will be very, very dependent on what we hear from the RBNZ Governor Glenn Stevens, and he will be talking 5 minutes after the announcement. So the announcement is at 8 o'clock p.m. London time, and his press conference is going to be at 8:05. So that is kind of one of those wait and see factors, I guess. But it's certainly a more interesting central bank meeting coming from the RBNZ than some of the other central bank meetings we've had to put up with, like the Bank of England, whereby they do nothing. The Bank of Japan seem like they're firmly on hold as well, which I forgot to mention actually when I talked about dollar yen. But basically, it's not really that market moving at the moment. So what we're seeing, as I said, one thing I did forget to mention with the RBNZ. So obviously the two risks are, even though we think that the chances, 90% chance is that they're going to hike interest rates as the market expects by 25 basis points. Otherwise, they'll look foolish. There's probably a slight chance that they don't do anything, and also a slight chance that they hike by more, by 50. That would really kind of, put a rocket under the Kiwi, I think, and not just under the Kiwi versus the US dollar, but under Aussie Kiwi as well. We could really see some weakness in Aussie Kiwi if they do more. That wasn't right. Sorry, guys. If they do more than expected, a 50 basis point increase would be very, very aggressive and could be something that would trigger a sharp decline in Aussie Kiwi. We don't think they're going to do it. They're no way going to be ballsy enough to do that. And it's not the right environment. There are growth fears and everything else. So as you can see here, I think that if they were to get more than expected 50 basis points, then we could easily make fresh multi-year highs. As you can see here, let me just put the max chart on here. We could probably get down to, maybe even these 2006 highs, whereby we're kind of around about 104.50 if they were to surprise the market. Now, we think they won't. But overall, if they sound like they're going to embark, they confirm that they're going to embark on a hiking cycle, then that could weigh quite heavily on the Aussie Kiwi, because obviously we know the RBA is nowhere near hiking, even though they have moved to a more neutral stance. So does anybody have any questions? I'm sensitive to the fact I've been speaking quite a lot. If someone has a question, then let me know. Otherwise, I'm quite happy to take a quick look at gold while you all muster your thoughts. As you can see with gold, we're just hovering around these highs now at 13. We're currently kind of, backed away from these highs, which come in around about just ahead of 1360. 1298 still looks like very, very good support. In terms of where we could go on the upside, just bear with me a minute. Let me just annotate this chart. Obviously, we're kind of looking at 1373, but we are looking as well, as you can see, 1336 is very good support. That's the 61.8% retracement of that August to December low, late December low in the gold price. That's acting as very good support at the moment. Obviously, if we get below there, then that could suggest a sharper pullback, maybe to that 1300 or 1298 level. But for now, as long as we stay at that level, then it's looking, we could potentially increase some of the scope for further upside, I should argue. But with gold, like with a lot of things, we are just kind of treading water. It's been very frustrating. Every time it looked like we might push higher, we've turned around again. But at the moment, 1336 seems like fairly good support. Even though I know those of you trading it, that would be quite tight. You might want to just widen it maybe to the 1306 level. Okay, guys, I think that's it from me at the moment. Thanks, Ray, for joining. That's always good. Unless there's any other questions, I'll probably let you go, actually. Again, it's just one of those frustrating weeks. We've got to see how things pan out. Remember, next week I'll be doing this, but it will be it will come again at 11 o'clock. It will be the normal 11 o'clock time, which I know it seems to work better for a lot of you. But I do thank you so much for participating and for joining early. So, Pan, you want a quick one? How do I see the Aussie? Well, the Aussie is interesting. Again, it's in a bit of a holding pattern. It seems like, with weak data out of China, I also wrote something about the Aussie dollar and iron ore. Let me just send that to you as well. Because obviously there's, commodities are coming under pressure. China's coming under pressure. That tends to be bad news for Aussie. So this is certainly something, just bear with me one moment, guys. That's certainly something to watch out for. There we go. So as you can see here, with the Aussie, it's just in a very traditional holding pattern. 89.25 is capping the downside of this month so far. With right now, 90.63 is a key support level that we haven't really been able to get above, a key resistance level, that we haven't really been able to get above with any gusto. That is a 100-day moving average. A daily break above there would be very positive and would open the way to those highs that we saw at the end of last week at 91.5. And then potentially to 91.61, but there was some selling interest around about 91.61. So right now, there is an employment report coming out of Australia this week as well. So it will be interesting to see that. Whether or not, if we get a weak employment data, then we could easily turn around and get down to those low 89 levels, maybe drop 100 pips from here. The employment report comes out on the 13th, so just after midnight, just into the 13th. of February. So that's kind of a key thing there. All right, everybody, thanks so much for joining, and please join us next week for more.